Presented by chargebackgurus.com.
The essential role of payment processors. To thrive in the interconnected world of e-commerce, merchants can't just handle everything on their own. Partners and vendors provide merchants with their network connections, web hosting, and many other specialized services, such as credit card processing. Every day, merchants rely on their payment processors to make it possible for them to accept the card transactions that make online shopping possible. Your relationship with your payment processor is an important one, and it can have a big impact on your bottom line. What do payment processors really do, and how can you choose the best one for your business needs? In both card-present and card-not-present environments, making a credit card payment has become a swift and seamless process. The customer provides their card information, the transaction is authorized, and payment is complete. It all transpires within a matter of seconds, despite the fact that quite a lot of behind-the-scenes communication is happening to make sure everything is carried out properly. While there are many entities involved in every credit card transaction, the payment processor does a lot of the heavy lifting. Payment processors make their money by charging fees for the transaction activity they handle, including chargebacks, which are detrimental to the overall payments ecosystem and can have a negative impact on everyone involved in them. What is a payment processor? A payment processor functions as an intermediary between the merchant and the banks that issue credit cards to consumers. When a customer uses their card to pay for a purchase, the payment processor receives the transaction details from the merchant and relays them to the issuing bank. If the issuer cannot authorize the transaction based on the data provided, for example if the card is expired, the billing address is incorrect, or the account doesn't have sufficient funds to cover the transaction, the payment processor will communicate this to the merchant. Otherwise, the transaction will go through, and when the merchant settles their transactions for the day, the payment processor will facilitate the transfer of funds from the issuer to the merchant account. Payment processors will often furnish the merchant with the hardware, payment terminals, card readers and the like, and software they need to process card transactions. Every time the payment processor processes a transaction, they will charge a transaction fee, which includes the interchange fee that gets paid to the issuer and card network, as well as the payment processor's own per-transaction fee. This is in addition to any fixed service fees the payment processor may charge on a monthly or annual basis. And of course, there are chargeback fees as well. What's the difference between a payment processor, a payment gateway, and an acquirer? The roles and terminology for the service providers who assist merchants with credit card payments are not rigidly defined, so it is not uncommon to see terms used in interchangeable or overlapping ways. Payment gateways are the software interfaces that handle communications between the cardholder, the payment processor, and the issuing bank. All-in-one payment platforms like Square and PayPal may combine gateway and processing services in a single package. An acquirer or acquiring bank is the financial institution that provides merchants with a merchant account, which is a special type of account that is allowed to receive deposits from credit card transactions. Some acquirers also provide payment processing services, so it is possible for your acquirer and your payment processor to be one and the same company. How does payment processing actually work? There's a lot going on even in the simplest credit card purchase. The process typically plays out like this. 1. The cardholder pays for their purchase by providing a credit card. They either scan it in at a payment terminal, brick-and-mortar stores, or enter the payment credentials at the checkout page, e-commerce. 2. The payment gateway securely transmits the transaction data to the payment processor. 3. Through the card network, Visa, MasterCard, etc., the payment processor connects to the issuer to authorize the transaction. 4. The issuer sends an approve or decline response back through the card network. 5. If the transaction is approved, the gateway can then negotiate the transfer of funds from the issuer to the card network. 6. The card network will then transfer the funds to the acquirer. 7. The acquirer deposits the funds into the merchant account, completing the payment process. What should merchants look for in a payment processor? It's up to the individual merchants to decide whether an all-in-one platform makes sense to them, as opposed to contracting with individual providers for processing, gateway, and merchant account services. One thing that should be at the top of the list of every merchant's list of requirements is for their payment processor is reliability. A payment processor that experiences frequent network outages can end up costing you a lot of money for every minute they're unable to process transactions. Price is another big concern for many merchants, and this is where chargebacks come into play. Card networks will sanction acquirers and payment processors whose clients are responsible for putting excessive amounts of chargebacks into the payments ecosystem. So, payment processors may terminate the accounts of merchants who carry a chargeback rate of 1% or higher for very long. Merchants who suffer this fate may find that the only payment processors willing to work with them are so-called high-risk processors, who charge very high rates and may not be as reliable as regular payment processors. The fees by these processors can cut deeply into a merchant's revenue, so it's very important for merchants to keep an eye on their chargeback rates and do everything they can to keep them well below that 1% threshold. Conclusion: merchants need to be able to count on trusted partners and vendors to support the tasks and business operations that can't be handled in-house. Payment processing is one of the most vital outsourced operations for any merchant, especially in e-commerce, where nearly every transaction involves a payment card. A reputable, affordable, and reliable payment processor can give you the peace of mind of knowing that you won't miss out on sales due to processing errors or unexpected downtime. Preserving a good relationship with your payment processor means keeping your chargeback rates low. When chargebacks become difficult to manage, it can help to enlist the services of another trusted partner, a chargeback management firm that can provide expert analytics and advice to help you uncover the root causes of your chargebacks and develop strategies for preventing them.
To learn more, visit chargebackgurus.com.